Good morning, everyone. Today is October 29th, 2025. This is before the market opened. Yesterday, we put up 3 cover calls yesterday. Basically, last Friday, a really good inflation number. That inflation was in check and the market was up 400 points. And then Monday, up another 400. Yesterday, up another couple hundred. So we'll have this Friday, and then Monday we gapped up, and then yesterday we have this. So it's 3 consecutive running day. And this is the QQQ on the bottom market, and usually the market one runs 3, 5, 7 days consecutively. Now, but this Friday, we're going to have unemployment number coming out. So that could change the market. Could continue to runs up, or it could turn around almost sideways. Who knows, right? The whole game plan is we will pull out some trades, the cover calls, to capture consecutive runnings, making new highs on the bottom market. And then the next tranche depends on Friday. We can determine whether we pull out the rest of the cover call or not. That's the game plan. So basically, we put out the video. We did some really nice. Yesterday had a nice run. We did some 30 days out cover calls. 45 days out being ideal, so 30 days, that's totally fine. Yeah, the other option was say around 60 days, so that's like way too long for premium to decline, so pick the 38 days. And basically, we just go for the dirty delta, plus or minus on there. And one for the dirty delta. The other one is there was the Apple, the short call on Apple too. Here there we go. Yeah. So we did also the Apple cover code. Again, 79, 285 strike, delta 25 delta. So 37 days less because that was yesterday. 285 delta. I'm sorry, 285 strike. Yeah. So the delta around 25. I sold this cover call around 345 each contract. We also did TSM. And oops. There we go. Okay. So we also did a TSM. I also did a TSM cover call. 325 strike, delta around 30, not 30, so let's make the correction. On 30, and it was around 55 each, so we're doing 10 contracts or so. So now it all dependent on Friday, where it's going to end up. Then that would determine whether or not we'll do another tranche. The way this was construct, again, I look at it and I use the Fibonacci retracement, and so you do a projection. Okay, so you do a projection. I need more scale. Yep, there we go. So it depends on what price and what range you want to do. So this is the initial first one. Go. Yeah. There it is. So we did 210. 210. And delta itself being more important than the fifth numbers. Fibonacci's retracement number, basically. These works really well more on retracement than an upside, but we can use that engage to help us. And then I will end the layout, fundamental analysis, doing a quick glance at the discount cash flow models. So I type in, you can Google Apple DCF as discount cash flow, and then usually I use this website, Guru Focus, because I can tweak the growth rate, basically. So according right now, if you look at the growth rate of 10 years growth rate of 15.9, the fair value is this much, stock price is way overvalued, right? So what we can do is change the growth rate to see how much growth rate you need to get the stock price current price of 269. So let's go 20% growth rates. One right there. Okay, so around 20% growth rate expected. But the thing is, you can also treat the terminal value. So what is terminal value? Represent the estimated value of business that is beyond the forecast period. So outside of 10 years, how much at the end, how much you will grow year over year. Let's say the company continue to go on perpetually forever, right? So that is another estimation you put in. Right now, this model, they're putting in 4%. I'll move it up. Let's say 6%. Now, if it's 6%, let's treat this back down. There we go. Now I go down to 20. So as you see, the relations change. These are the two major factors that will affect your DCF model, actually. Good. Next 10-year growth rate, and then your terminal value. But this is assuming everything. This is average for me to say. Net reality. What analysts does is actually they will have of variables. As they project out. 2 years, 3 years, that growth rate would change. So that's one way to do it. But this would give us a fast way to look at what growth rate on the average we need, given the terminal value that you put in. Shrink it to 8. See what happened, right? Then you could that just become low. It's around there, right? But typically about $156 perpetually. That's a little low, I would say, when I text that. But that's just give you a quick glance estimate. And now we'll go to Yahoo and look at the analyst coverage. I will look at year over year, like quarter over quarter, but year over year, how are things looking? In that sense. Auto, smart home, earning per share. So it's looks pretty steady, pretty linear, but overall a slight uptrend. That's what we want to see, a slight aggressive uptrend. On projection, so that now is where the stock have much more better stable growth potential. Like we're looking for stable growth as a whole. So that is one quick way to look at this kind of cash flow model that will help us out. But we'll go back to our technical analysis. We're doing options. We're doing 6 weeks out, 45 trading days options, and fundamental analysis. Usually, you project take anywhere from half a year to 18 months to fully play it out. So that's your long-term investment use fundamentals. But when we use options and it's a return to collect rent, like of course, what we're doing is collect rent. What we use also take a quick look at DCF model and the fundamentals, but that doesn't dictate. Now, what dictate is what is the market doing, where you want to go, and what way are the technical forms, and the probability of your winning rates, basically. So that's why you use the delta, and then we also use the Fibonacci with trace one, and we're also looking moving average, the MACD, and all that stuff. Like take a look at MACD, cross up over, that's great, but although we make new high, here's the problem. There's a problem in the MACD, so the momentum of the MACD is lower than the previous high right now, but it hasn't crossed over yet, so we'll wait for it to cross back over, like here when it crosses, when it peak, it's where it matters. But right now the peak is lower than the previous peak, while the instrument make new high. So that's a little concern. So that's why I say, okay, 3 days of run we put off the first tranche. 2 more days of run, Friday and unemployment number come out. We'll see if we're going to put the next tranche or not. And we're just collecting rent. Basically, an cover call is a way to get paid for the staff to go to your price target. And we do cover call for that. Okay, so that's for today. Thanks for watching.